It's time to move away, however, from the Mag 7. I want to bring in with $6 billion in assets under management, Crescent Grove Advisors co-CIO Andrew Krei. Andrew, so you're saying get away from the Mag 7. We have other guests that say that you buy the dips and you stay with the Mag 7. Your thoughts?
Yeah, I think we've just gotten to the point where the expectations are so extended. I mean, look back at Alphabet's earnings last week as a perfect example. Incredible growth rate. By all accounts, a phenomenal business, needless to say. But I think you just look at the reaction to what they said in terms of their CapEx program, prospectively, the build out of all the AI infrastructure, the compute infrastructure required, and the stock sells off, despite the fact that, again, they had 80+% growth in their cloud business, a lot of really good things you could point to from a fundamental perspective. So we kind of take that as, the analogy now for looking at Meta, looking at Microsoft, looking at the other Mag 7 members and just saying, has the bar been set so high for these businesses? Is there not other kind of relative value opportunities within the market as we see pretty good, breadth to earnings growth this quarter and prior quarters? I think going forward for the balance of the year, that to us looks like the rotation trade that investors ought to be looking for in their portfolios right now.
But the question is the rotation over-rotated? That's my thought. But at the same time, then where do you put your money? Where are you making money work if it's not going to be in the Mag 7?
Yeah, so we would look at sectors like healthcare, like financials, things that would typically populate like value indices. One thing to look at, an interesting, sort of segment of the market way to slice this would be high beta stocks. So think about momentum, which would tend to be populated by those tech names, chip names versus low beta, which again would be more conservative, defensive type segments that I just referenced in some cases. And what we've seen is kind of this ratio, right? We've seen this correction between those two segments of about 20% at this point. You tend to see that happen every so often where you get, high beta corrects relative to low beta to the tune of 20 to 40%. And we're coming off an incredible move to the upside on momentum that sort of mirrored what we saw in 2020 and 2021. So we think that, part of this is just the normal kind of cadence of markets, right? The rubber band gets stretched too far, it snaps back. But to us, there's still real underpinnings of kind of fundamental value in these other segments of the market that I referenced, where, again, that relative value opportunity presents itself for investors to rotate some of their capital.
Real quick before you go, just kind of a macro question to you. We heard from Kevin Warsh. We had a Fed rate decision today. What's your overall view of the markets moving forward?
Yeah, well, I would say certainly a paradigm shift at the Fed in terms of the way that he was presenting, kind of taking the market, letting the market provide the impetus for the Fed in terms of their policy going forward, as opposed to the Fed trying to be more of a top-down, dictating policy to the market. And I think you're seeing that within Treasury yields. The 10 years pop, the 30 years pop to the upside here, which, again, that's going to challenge longer duration, momentum, speculative type stocks.
There you go.
We got tech names in particular.
Thank you, Andrew. All right, guys, 13th.